Very good evening, all of you. Please confirm if you can listen to me properly and my screen is properly visible. Please confirm if everything is fine. All fine. Very good. Thanks, Diksha. Now, okay. So let's start our day 3 of the revision series for September 2022. Now, we have covered almost 10 topics in our day 1 and day 2. Now it's our turn to finish up the rest of the topics. Now, so today we will be covering, as you already know, today we will be covering financial instruments, inventories, biological assets, and reporting financial performance, which will cover two topics, which one of them is effects of changes in the foreign exchange rates, and the another one is non-current assets held for sale and discontinued operations. So we'll be covering these 5 topics in the today's class. Let's start the discussion of each of them one by one, starting with the financial instruments. Now, before we start the chapter financial instruments, let us understand the meaning of the few terms, okay, so that it becomes easy for us to understand the overall chapter. First, let's understand what is the meaning of the term financial instruments. So, as we know, the financial instruments means what? It's a contract. It's a contract between what? Two or more persons, between two or more persons or entities, it can be, right? Now this contract will give rise to this contract will give rise to equity, or I can say this contract will give rise to financial asset for one party, financial asset for one party, and equity or financial liability for another party, equity or financial liability for another party, right? So one party will get financial asset and another party might get either equity or financial liability, I hope that is clear to all of you. Now explaining the meaning of what is the meaning of equity, what is the meaning of financial liability, and what is the meaning of financial asset. So starting on with financial liability, now so financial liability, as you know, it's a contractual obligation. It's a contractual obligation to deliver cash or any other financial assets, Now what is the meaning of contractual obligation? As we were discussing in the last class also, obligation means anything which I am bound to, means I cannot avoid, meaning thereby if the entity is in a position, whereby entity has to deliver cash or any other financial asset, and the entity is bound to deliver cash or financial asset, in that case we can say it is a contractual obligation, and hence it is a financial liability, right? Now the financial liability will be settled by cash or any other financial asset, if it is settled by execution of services or delivery of goods, that's not a financial liability. So financial liability is a contractual obligation which will be settled by delivery of cash or any other financial assets. Now comes the question, what is a financial asset? This is a contractual right. So understand this one. This is a right, this is an obligation. Right to receive cash or any other financial assets, So what is the example of financial asset and what is the example of financial liability? Let me give an example. Of financial asset. It can be cash, it can be trade receivables, right? It can be investment in equity shares, it can be loans given, etc. Now what is the example of financial liability then? So financial liability, the example is where I am contractually bound, means loans taken from bank, Don't you think if I've taken a loan from the bank, I am contractually bound or I am obligated towards bank to repay the loan, right? The interest portion and the principal portion both, right? Now you can say trade payables, or which we say is as creditors also, right? etc. These are called the financial liabilities. These are called as financial liabilities. Is it clear, guys? The meaning of financial instruments, the meaning of financial assets, and the meaning of financial liabilities. Is that clear, everyone? Now coming on to the fourth definition, that is equity. What is the meaning of equity? So equity is the residual interest in the net assets of entity after paying off all its liabilities. After paying off all its liabilities. What is the meaning thereby? See, basically, as we already know, the equity means what? The ownership. The equity represents ownership. Now let's suppose if I have started my own business with rupees with $10 lakhs or $1 million, okay, and I have taken a loan from the bank of let's suppose $1 million, okay, so $2 million I have started my business. Now after some years passed by and I want to shut down my business, okay. Now the net assets of my business is, let's suppose, $1.5 billion. So out of 1.5 billion, can I say that 0.75 billion belongs to me and 0.75 billion belongs to the bank because we both contributed equally to the business? No. Out of 1.5, first I will pay off the 1 billion, that is the external loans, right? That is the financial liability. What remains is the equity. And it might also be the case that the net assets of the entity or at the time of shutdown is $6 million, and in that case also I have to repay only 1 million to the bank, right? So 5 billion belongs to the equity. So whatever is the residual portion belongs to the equity. Now that's the definition of an equity, financial assets and financial liabilities. Now let me prove the meaning of financial instruments, to you guys. Let's suppose, example, A gave loan to B, loans. So now for what does it become? For A, what does it become? A has given a loan, so it is a financial asset for A, and for B it is a loan taken, means financial liability. Now again another example. See, what does it happen? For one party financial asset, for another party financial liability. Reliance Industries has issued equity shares to general public. Or we can say it as an investors. For investors it is financial asset, but for Reliance Industries it is equity. Is it clear, guys? The meaning of the financial instruments, the meaning of the financial assets, the meaning of the financial liability, and the meaning of the equity instruments. Is it clear, everyone? Okay, now second point is we have to understand there is a difference between the term liability and equity, right? What is the difference? What is the difference? The ultimate difference is in liability. In liability, we have a contractual obligation. We have a contractual obligation, which is not the case. Which is not the case with equity. Which is not the case with equity. In equity, we do not have any obligation. We do not have any obligation. We do not have any obligation. Whatever remains belongs to equity. No contractual obligation. But liability has a contractual obligation. Liability has a contractual obligation. Is that clear, guys? Now coming on to the third part, that is compound financial instruments, and which is you can say, I'll write here as well, most tested topic in exam from financial instrument chapter. This is the most important topic. Compound financial instruments, right? See, compound financial instruments means what? An instrument which has the features of equity and liability both, right? Which has the features of equity and a liability both. I'll write here, equity plus financial liability, both features are there, right? Now, but the question, how will we deal with these cases? As part of step number 1, first we need to identify what is the equity portion of this instrument and what is the liability portion of this instrument, right? And then we will measure the liability portion and then we will measure the equity portion. But before we measure that, first we need to classify that which portion of this instrument belongs to equity and which portion belongs to liability. But before we do that, understand, guys, any instrument will have three strips, three components, three parts. What are three parts? One is the principal part, another is the interest part, another is the conversion rights part. Conversion rights part means this instrument will get converted to equity after certain period of time. This instrument will get converted to equity after certain period of time. Why conversion rights? Because understand, guys, if the instrument is an equity as of now, then that's an equity instrument. That's not a compound financial instrument. So what happens? This is as of now, it is a liability component, but in the future it will become an equity component. So there will always be a conversion right. There will always be a conversion right in case of a compound financial instrument. There will be a conversion right in case of a compound financial instrument, and we need to understand this conversion right gives the investors a right to convert the instrument into equity. So always treat the conversion rights as an equity, that this is an equity component. Conversion rights are always equity component. Okay, now talking about interest and dividend. See, you have to understand that whenever you see the instrument, understand whether the interest or the dividend, whatever is there. See, guys, understand this. We will not go as per the names. What student make mistake is, if they see dividend, oh, that's an equity. If they see interest, oh, that's a liability. Don't do this way. Whatever is the name, whether interest or dividend, see whether there is a contractual obligation or not. If there is a contractual obligation, then that's a liability. If there is no contractual obligation, that's an equity. Let me give an example. The entity has taken a convertible loan. The loan will be converted to equity shares after 3 years, and on that loan, the company has to pay 9% interest. 9% interest every year. 9% interest is a contractual obligation. That's a financial liability. Company has to pay interest every year, but the interest is dependent on the profits. The interest is dependent on the profits earned by the company. Tell me, can the company avoid the paying of interest in that case? If there is a loss, can the company avoid? Yes, the company can avoid. Is there a contractual obligation? No, there is no contractual obligation. So in that case, it will become an equity. Even if it is an interest, the name is interest, it might become an equity. Let's talk about dividend. Dividend on preference shares, 10% dividend on preference shares has to be paid every year, right? So even if the name is dividend, it might be a financial liability. So don't get fascinated by the name, that is interest or dividend. Assess whether there is a contractual obligation or not. if there is a contractual obligation that the company cannot avoid, unavoidable payment, then that's a financial liability. If the company can avoid, then that's an equity. Okay, now coming to principal. Now, if the principal, there is a contractual obligation to deliver cash, means the principal will be settled by delivery of cash or any other financial asset, that's a financial liability. But if the principal will be settled by conversion to equity shares, what will we assess? We'll assess whether the conversion is compulsorily convertible or not. Whether the principal is compulsorily convertible or optionally convertible. Principal is compulsorily convertible or optionally convertible. Now, whenever it is convertible, understand that it should be convertible into fixed number of shares. That is called fixed to fixed test. Okay, always remember that it has to be converted. Into fixed number of equity shares. If there is no fixed number of equity shares, don't assess anything. It will be directly be a liability. If it is variable number, I'll write here. Okay, I'll write it here. See, principal can be settled by three ways. Either by delivery of cash, then in that case it is a financial liability. Either by delivery of equity shares. Okay, and if the equity shares is through variable number of equity shares, okay, then again that's a financial liability. If it is fixed, then assess as per chart. Above. Okay, if it is variable number of equity shares, to be issued, then it is financial liability. I hope it is clear, guys. We'll take up an example definitely and explain it to you guys. Now coming back to the chart. Now if the equity shares are compulsorily convertible into fixed number of equity shares, then it is equity. Now if it is optionally convertible, into fixed number of equity shares, okay, but now if it is optionally convertible means either the conversion option is with the holder or the entity, or the question is silent. See, what happens ideally is whenever an instrument is issued, it says that at the end of 3 years, this instrument will be compulsorily convertible to equity shares. Okay, one is compulsory, definitely it will be convertible. In that case it will be equity if it is fixed number. Second type of instrument is, it says that this instrument will be convertible to equity shares at the option of holder of the instrument. That is, let's suppose if I have the instrument, at the end of 3 years, if I want, I can take cash. If I want, I can take equity shares. If I have the option, holder has the option. If I am the holder, you are the entity. Now, what will happen? You have given me an option. That at the end of 3 years, Vishal, either you can take cash or you can take equity shares. So that's an optionally convertible equity shares. Right? Optionally convertible. Or the option can be with the entity as well. Right? So in that case, it can be financial liability or equity, because if the option is with the entity will see which one is beneficial for them. Right? So accordingly entity will classify. But yes, this is not in our syllabus, so we'll not discuss this one. This we have in our syllabus. Optionally convertible, holder has the option, and if the holder has the option, we'll classify it as financial liability. The question is why. Okay. Now you are the entity and I am the holder. You have given me an option that if you want, you can take cash if you want, you can take equity shares at the end of 3 years. Let's suppose like me, there will be n number of investors for the company, right? Let's suppose one of the investor comes to the company entity and asks, no, I want cash. Can the company deny? Can the company deny? No, the company cannot avoid the payments, right? So hence it is a contractual obligation, and it becomes financial liability, and hence it becomes financial liability. If the question is silent, whether the holder has the option or the entity has the option, assume that the holder has the option. Assume that the holder has the option. Assume that the holder has the option. Is that clear, guys? Is that clear, guys? And if the holder has the option, financial liability. Now, third type of instrument can be, one is compulsorily convertible, one is optionally convertible. One, the question is silent. The question will only say convertible instrument. Assume it is optionally convertible. Assume it is optionally convertible. Now, I will give you one hint. I will give you one hint. If the question says that it is a convertible instrument, but it doesn't say it is compulsorily or optionally, what will you assume it to be? What will you assume it to be? Optionally convertible? Now, if the question was silent, whether it was compulsorily or optionally convertible, then definitely the question will not specify who has the option. If the question is silent on whether it is compulsorily convertible or optionally convertible, and we have assumed it is optionally convertible, then definitely the question will also not specify who has the option. So in that case, what will we assume? In that case, what will you assume? Holder has the option. Holder has the option. Holder has the option. Now, if holder has the option, what will it become? That principal component will become what? Financial liability. Principal component will become what? Financial liability. Always keep this in mind. Most of the question revolves around this logic. And students solves correctly in the exam, but yes, they don't know the logic behind this one. So you have to be aware of the logic behind this one. Is it clear, guys? Is it clear to all? If the question solely specifies that this is a convertible instrument, right? Now, okay, how will we do the accounting for this? Now, what will you do is, first you will calculate the present value of the contractual cash flows which you have classified as financial liability, right? Present value of the contractual cash flows at the rate, which rate? At the rate, market rate of instruments without conversion option. Without conversion option. And this present value will be your financial liability. Okay, and what is equity? The issue proceeds minus financial liability will be your equity. Issue proceeds, whatever amount the entity has got by issuing the instrument, minus the financial liability that you have calculated in step 1 is your this one is your what we say it as equity amount, is your equity amount, right? Now let's solve the questions. Let's solve certain questions, guys. Let's solve certain questions. For financial instruments, let's solve certain questions for day 3. Certain questions. Okay, Now, question number 97 taken from a BPP book. Question number 97. Let's solve it. An 8% 30 million convertible loan note. Now see, convertible loan note. Does it say optionally convertible or compulsorily convertible? No. So what will we assume? Assume that it is compulsorily optionally convertible. Assume that it is optionally convertible. If it is optionally convertible, is the question saying that who has the option? Who has the option C? The loan note is redeemable at par on 31st March or convertible. Oh, the question is saying that it is optionally convertible. The question is saying the loan note is redeemable at par on 31st March or convertible into equity shares at the option of the loan note holders. That the holder has the option. The question is clearly stating that on the basis of 30 shares for each $100 amount, $100 of loan. Means for every $100 of the loan, it will get converted into 30 equity shares. So the number of equity shares is fixed or variable. Number of equity shares is fixed or variable. Number of equity shares is fixed or variable. The number of equity shares is fixed or variable. Fixed, right? Very good, Naman. Very good. Now let us solve this question. Question number 97. Question number 97. Okay, 8% 30 million convertible loan was issued. Okay, now so again let's break this instrument into three parts. One is principal component, another is interest component, another is conversion rights. Conversion rights, as we already know, it is always equity. Now interest and principal. 8% 30 million convertible loan was issued on 1st April 2005 at par. Interest is payable in arrears. Interest is payable in arrears at 31st March, means payable every year, right? So interest is a contractual obligation and hence a financial liability. Interest is a contractual obligation and hence a financial liability. The loan note is redeemable at par on 31st March 2008 or convertible into equity shares at the option of the loan note holders. If it is convertible at the option of loan note holder, then it will be what? Tell me. Optionally convertible at the option of holder. Tell me, it is what? It is what? It is financial liability. It is financial liability, right? Now, step 1. Calculate present value of contractual cash flows. So, what are the contractual cash flows? One is interest and one is the principal, okay? So, present value of interest payouts. Present value of interest payouts, that is equals to what? 30 million into 8% is 30 million into 0.08 is 2.4 million every year. 2.4 million every year multiplied by what is the this one? You at the rate of interest rate for similar instrument without conversion option is 10%. So for 3 years it is 2.49 is the annuity factor. So 2.49 is the annuity factor. If we multiply this one, it comes to 2.4 multiplied by 2.49 is 5.976. And present value of principal component is how much? 30 million, right? 30 million multiplied by what is the present value factor? 0.75 into 0.75 is equals to what value? 30 into 0.75 is 22.5. So what is the total financial liability? So financial liability is 5.976 plus 22.5 is 28.476 is your financial liability. 28.476 is the financial liability. And now what is the issue proceeds? What is the issue proceeds? 30 million, right? 30 million. So what is the equity? What is equity? Equity is 1.524 million. 1.524 million. Right now, what is the question asking for? What amount will be credited to equity on 1st April 2005 in respect of this financial instrument? Answer is 1524. But now let's though we have solved this question, but let's since it is for 3 years only, let's solve it fully. Let's solve it fully, that how the financial liability and equity will be recognized for, right? 3 years, right? Let us solve it off. Instrument was issued on 1st April 2005, 1st April x5, 31st March x6, and 31st March x7, and 31st March x8. In this year, here the financial liability is recognized at what is the value of financial liability? 28.476, 28.476, and equity is recognized at 1.524. Now equity will remain 1.524 every year. Equity will remain 1.524 every year. Equity will remain 1.524 every year. Now what will happen to the financial liability? Tell me, financial liability is measured at what method? What is the method called for financial liability? It is called as amortized. Financial liability is measured at amortized cost method, right? Financial liability is measured at amortized cost method. Now let me tell you how financial liability will be recognized. It is year opening financial liability, then finance costs at the rate of 10%, that is effective interest rate. Now minus contractual cash flows, then closing financial liability. So year 1, year 2, year 3, opening financial liability is 28.476. What is the finance cost? 28.476 multiplied by 0.1 is 2.85. okay. Now so what is the contractual cash flow? It is 2.40, that is 8% of 30 million. 8% of 30 million. So what is the closing financial liability? It is 28.476 plus 2.85 minus 2.40 is 28.926. 28.926. Now here it is 28.926. This one is 2.90. So this is 2.40. So 28.926 plus 2.9 minus 2.4 is 29.426. 29.426. Now here 29.426. Here it becomes 2.94. Here it becomes 2.40. Now so 29.426 plus 2.94 minus 2.4 is 29.66, that is 30 million. Now this 30 million can be settled by way of cash, can be settled by way of equity shares, can be settled by way of mixed, that is both, can be settled by both. So that's how it will be settled. Is that clear, everyone? This finance cost will be recognized in SPL. It will be recognized in SPL as finance costs. Is that clear, everyone? Always remember, whenever you are calculating this contractual cash flows, calculate on face value of the instrument and not the fair value of the instrument. Calculate on face value of the instrument and not on the fair value of the instrument. Okay, and this one should be calculated on fair value of the instrument and not on face value of instrument. Fair value at the rate of effective interest rate, right? On face value at the rate of coupon rate. This is how we calculate the contractual cash flow. This is how we calculate the finance cost, and the finance cost goes on to SPL and contractual cash flows goes on to cash flow statement, goes on to cash flow. Is it clear, guys? Everyone, is it clear, everyone? Is it clear, everyone? Now, so this is how we calculate for, okay, this is how we calculate this one, compound financial instrument. Please tell me, is compound financial instrument clear to everyone? Is compound financial instrument clear to everyone? Fair enough. Now moving on to financial liability, as we rightly discussed, financial liability is measured at effective amortized cost method, right? Amortized cost method. Now few things. Finance costs is calculated at the rate of effective interest rate method. Effective interest rate method on fair value of the instrument, on fair value of the instrument. And contractual cash flows at the rate of coupon rate, or the rate of coupon rate on face value of the instrument, on face value of the instrument. Many student, I have seen many students making mistake in this one, so please don't do that mistake. And I have already explained how the amortized cost accounting works, right? I have in the previous example, in the previous question number 97, I have already explained that how the amortized cost accounting works. Is that clear, everyone? The financial liability part, the amortized cost method part, the compound financial instrument. Is it clear, everyone? Is it clear, everyone? Any queries, anyone so far? Okay, now moving on to financial asset. See, financial asset, unlike financial liability, financial asset is divided into three parts. Financial asset is divided into three parts. What are three parts? One is amortized cost method, another is fair value through other comprehensive income, and the third part is fair value through P&L. Fair value through P&L, FVT P&L, FVT OCI, and amortized cost method. But the question comes up, how will we classify? How will we classify? So we need to understand the classification of an instrument. We need to understand the classification of the instrument, and then we'll understand the measurement as well. Now, to do the classification, there are two tests that are required to be done. There are two tests that are required to be done. Two tests. What are the tests? Test is test 1. Test 1 is business model test. The business model test, basically what is the objective behind holding this instrument? The objective 1, objective 2. Objective 1 is to hold till maturity. Objective 2 is hold till maturity plus sell for better returns. Sell if better returns are available. If better returns are available, sell if better returns are available. Okay. Test 2 is a contractual cash flow test. It says that the instrument should give only principal and interest on specified dates, Now the standard says that if the instrument is satisfying the criteria of business model test 1 plus contractual cash flow test, that is hold till maturity, plus it will the instrument will fetch only principal plus interest on specified dates, it is we will follow amortized cost method for that. If the business model test 2 plus contractual cash flow test pass, then we record it at FBT OCI, that is we will keep on fair valuing the instrument, and the changes in fair value will be recorded in other comprehensive income, and any other we will follow fair value through P&L account. Is the classification clear, guys? Now let me take up certain examples and discuss the classification for that. So examples are let's suppose a loan given. So the loans that we give, we generally intend to keep it till maturity and realize the loans, right? Realize the loans back. And when I'll give the loan, I will receive definitely the principal on a specified date and interest on specified dates, right? So that we follow amortized cost method for this one. Now investment in equity shares. Investment in equity shares. Investment in equity shares. Tell me, can my intent can be to hold till maturity, right? Or I can sell it for better returns. But tell me, does equity shares have any maturity? No, right? So though there is no maturity, business model test gets failed. Plus, even if we understand it, okay, we are holding it till for a very long period. We are holding it for a very long period. Then also we need to understand that there is no principal and interest in investment in equity shares, right? There is no principal and interest, and hence it will be classified as FVTPL. It will be classified as FVTPL. Okay, is that clear, everyone, guys? Is that clear, everyone? Is that clear, everyone? Let me take up one more example. Debtors hold till maturity and principal on a specified date, right? So we will follow amortized cost method for this one. We will follow amortized cost method for this one. For debtors, we will follow amortized cost method. Is it clear, guys? The classification is clear. Can we move on to measurement? Do you have any queries in classification of financial assets? Do you have any queries in classification of financial assets, or can we move on to measurement? Come on, guys, tell me. Akshit, Naman, Saksham, Vidisa, Manav, Saurav, Diksha. Yes, Dipti, tell me. Tell me your query, Dipti. If investment in equity shares is not for trade purpose, then it will be FBT OCI. I will cover that. Just hold on for a minute, Naman. I've already written a point for investment in equity shares. I'll deal with it separately. Apart from that, regarding transaction price, we'll discuss that in measurement. No, Priyanka. Other than financial instruments, there could be more items that come in OCI and P&L both. Exactly, Dipti, but we are talking about financial instruments in this topic, right? There can be other items that can come in P&L and OCI both. There are total of 6 items that goes to OCI. Other comprehensive income, there are total of 6 items. Like to give an example, one of them is you can say revaluation surplus that goes to OCI, right? And OCI is for disclosure. Exactly, Dipti. OCI is for disclosure. Basically, the intent of OCI is I don't want to recognize the gain or loss, but I want to disclose the gain or loss to the investors. I want to disclose the gain or loss. That's the reason you will see here that if my intent is to hold till maturity, but I can sell for better returns. So in that case, what I am doing, my classification falls under FVT OCI. So I don't want to record the fair value changes as in my P&L, because my intent is not to sell, my intent is to hold only, but I can sell if better returns are available. So in that case, the entity wants to disclose the fair value changes to the investors through OCI. Okay, is that clear, guys? Okay, fair enough. Let's move on to measurement. Now, in measurement, amortized cost, FBT OCI and FBT P&L. Guys, let's understand that initial and subsequent measurement both will understand. Okay, in amortized cost and FBT OCI. Okay, see what we'll do is we will capitalize amount paid, that is a purchase price, plus the transaction cost that we incur, that we incur. Okay, let's suppose we have taken a loan from the bank, okay, of rupees of dollar 1 lakh, and paying for taking that loan, or let's suppose I have given a loan to someone, okay, of dollar 1 lakh, dollar 100,000, okay, and I have paid rupees dollar 1,000 as a commission, or brokerage, So in that case, 100,000 plus 100,000, 100,000 plus 1,000, that is 101,000 will be capitalized as financial asset in case of amortized cost, right? And the same principle applies to the FBT OCI, but the same principle doesn't apply to FBT P&L. In that, we will just say capitalize at amount paid, and the transaction cost will be transferred to P&L. Okay, transaction cost is capitalized in this case. Transaction cost is capitalized in amortized cost and FBT OCI. Subsequently, fair value changes for amortized cost will ignore, but yes, fair value changes for FBT OCI we will transfer to OCI, and fair value changes for FBT P&L will be transferred to P&L. Now in this case, at amortized cost we will record definitely the finance income, because if in financial liability there was a finance cost, then in financial asset there will be finance income, right? Finance income will be recorded at effective interest rate, similar to financial liability, right? And we'll record this finance income in SPN and in SPL. Same thing will happen in FBT OCI as well. FBT OCI as well, right? We will record finance income. We'll record finance income in SPL. We'll record finance income in SPL. We will record finance income in SPL. And there will be no finance income in FBT P&L. Why? Because this type of instruments generally we record fair value changes in P&L. There is no finance income. If at all there is any finance income, we will record that in P&L. Okay. Gain on disposal will be transferred to P&L in all the three cases. Is that clear to everyone? The measurement principle is clear to everyone? Is measurement principle clear to everyone? If you have any queries, do let me know, guys. Clear? Okay, fair enough. Now let's move on to one more topic, that is investment in equity shares, which Naman also had query. See, ideally we understood just right now that investment in equity shares is recorded at FVTPL, but our standard says that if this equity shares is taken for long term and strategic reasons, then at inception we have the investor has an irrevocable, the entity has irrevocable option to classify it as FVTOCI. What is the meaning of irrevocable option? Meaning thereby, if you classify it as FVTOCI once, can it be reclassified to FBT P&L? No, it cannot be reclassified. That's the meaning of irrevocable option. And this option is available only at the inception. Only at the time of purchase you have an option. Later on you cannot change. From FBT P&L to FBT OCI. Okay, only once you have an option to classify it as a FBT OCI. Later on you cannot change from either from FBT P&L to FBT OCI or FBT OCI to FBT P&L. You don't have the option. At the purchase date, on the date of purchase, you have an option to classify investment in equity shares as FBT OCI. Now one more thing. IFRS 10, IFRS 10 and IAS 27, which deals with separate financial statements. These two standards also says that investment in group companies, investment in equity shares of group companies, investment in equity shares of subsidiary or associate can be measured at cost, okay. So that's what is the so you have to understand three things about these three things about investment in equity shares. Is that clear to everyone? About investment in equity shares, is that clear to everyone, guys? Okay, fair enough. Now let us move on to the next topic, de-recognition of financial asset. Okay, tell me, when did we recognize financial asset? Recognition happens when we have a right to receive cash or redeem the financial asset. Now, when will we de-recognize? When the right to cash flow expires. When the right to receive cash or any other financial asset expires, it is then we de-recognize the financial asset. Is that clear, guys? Okay, now factoring of financial assets. This is a very important topic for exam. Again, it has got tested multiple times in the exam. Very important topic. Now what happens, let's suppose entity has receivable, entity is Reliance. Okay, this entity is called Reliance. It has a receivable from Infosys, after 3 months. Okay, but Reliance needs the funds now. So what the Reliance can do? Reliance can approach State Bank of India, and Reliance can sell these receivables and receive the amount, right? And it can sell the amount, receivables and receive the amount, right? Now this sell that happens in two ways. Okay, with risk and without risk. Now tell me, if Reliance has sold the receivables from Infosys to SBI, from Infosys to SBI, with risk and without risk, okay, Infosys to SBI with risk, along with the risk means the reward is also of SBI and the risk is also of SBI, meaning thereby if the Infosys defaults in the payment, the risk is of SBI. Tell me, do you think anywhere Reliance is involved now, or Reliance can de-recognize the receivables from Infosys? So the standard says that if the sale of financial asset happens without recourse, What is the meaning of without recourse? What is the meaning of without recourse? What is the meaning of without recourse? Meaning thereby, if the Infosys defaults, SBI cannot come to Reliance for asking the payment. Okay, that means with risk, then it says that de-recognize financial assets. De-recognize financial assets. But if the sale of financial asset happens with recourse, meaning thereby if Infosys defaults in the payment, SBI can come to Reliance for asking the payment. Okay, that is without risk. Without risk. With recourse means SBI can recourse back to Reliance that your Infosys has not given me payment, give me the payment now. Okay, means the risk is still with the Reliance. Risk is still with the Reliance, right? Without risk, then in that case we cannot de-recognize. We cannot de-recognize FA. Rather it is a case of factoring of FA. It is a case of factoring of financial assets. And how will we treat factoring of financial assets? So what will we do is, in factoring, what will we do is continue recognizing financial asset. Now amount received on sale of financial assets, treat it as loan. Treat it as loans, right? Treat it as loans. Is that clear, guys? Is it clear, guys? Exactly, Santosh. Risk is transferred in non-recourse basis. See, this is non-recourse basis. So with risk is transferred here. That's what I am telling, Santosh. Non-recourse means it cannot come back to me. SBI cannot come back to me to Reliance. SBI cannot come back to Reliance if Infosys defaults. That means risk is also transferred. Okay, I'm just explaining the meaning of the term with recourse and without recourse. Okay, I hope it is clear. The factoring is clear. Factoring of financial assets is clear to everyone. Please confirm, guys. Is the factoring of financial assets clear to everyone? Anyone having any queries in financial instruments chapter now? We'll definitely solve certain questions, but before that, tell me, is it clear to everyone, the financial instruments? If you have any queries, you can write down in the chat box. Till that time, we'll solve certain questions. Okay, let's solve certain questions. So we have already solved 97. Let's solve other questions. Let's solve 100. Question number 100. On 1st January 20x1, Penfold company purchased a debt instrument at its fair value of 500,000. It had a principal amount of 550,000 and was due to mature in 5 years. The debt instrument carries a fixed interest of 6% paid annually in arrears and has an effective interest rate at the rate of 8%. It is held at amortized cost. Let me see who can answer it correctly. So the instrument was issued on 1st January 20x1, and you need to find what is the value of debt instrument on 31st December 20x2. Tell me, guys, what is the answer? Let me see who can answer it correctly. Question number 100, guys. Fastly, please. Guys, all of you who are watching the revision series, please like the video so that it reaches the larger audiences. And it is beneficial for larger audiences. So please like the video, guys. Please like the video. Okay, tell me what is the answer, guys. Question number 100. What is the answer? Let us solve this question. 514560. 514560. Naman and Akshit have already answered. Very good. Let me just solve it and see what is the answer for this one. This instrument is issued on 1st January X1. Purchased at what amount? Purchase price is 500,000. Okay, everyone is giving an same answer, so it seems it is correct. Principal amount, that is face value, its face value is $550,000, right? Now, so what is the coupon rate? 6%. Is the coupon rate is 6%. And what is the effective interest rate? So finance cost, effective interest rate is 8%. So now what is the finance cost? It's 40,000 minus what is the contractual cash flow? So that is 55,50,000 multiplied by 0.06 is 33,000. So that comes to 5,40,000 minus 33,000 is 5,07,000. This is on 31st December X1, but we need the value on 31st December X2. So finance cost again at the rate of 8% is how much? Is 40560. Contractual cash flow is remain the same, that is 33,000. So what is the value on 31st December X2? It's 5,07,000 plus 40560 minus 33,000 is 514,560. 514,560. I'm really thankful to all of you. I think the intent was achieved. All of you have answered it correctly. Very good, guys. Very good. Coming to question number 102. Dexon Company's draft financial statement of financial position as of 31st March 2008 shows a financial asset at the fair value through profit and loss. Okay, it says for question number 102 that there is a financial asset at fair value through P&L, okay, and which is recorded on 1st April X7 at $12.5 million. At 12.5 million. Okay, the financial assets are held in a fund whose value changes directly in proportion to a specified market index. Okay, now it says what is the amount of gain or loss should be recognized on 31st March 2008. So what is the value on 31st March 2008? Value, so it says the value of index, as on here is 1200 and the value of index as on here is 1296. So what is the value of the investment? So it is $12.5 divided by 1200 multiplied by 1296 which comes to dollar 13.5 million, right? And what is the value changes? Dollar 1 million. Dollar 1 million is the value changes, right? But see, what is the question asking? Enter your answer to the nearest whole dollars, right? So you will have to write 1 million. You will have to write 1 million like this. You have to write 1 million like this in the answer. Is it clear, everyone? Is it clear, everyone? Very good, Akshit. Very good, Naman. Now let's solve one more question. 103. On 1st January 20x8, Zipa company purchased 40,000. Okay, let me just write it here. The question. Vidisha, writing 1 million 1M will not work. You have to write fully, like how Naman and Akshit have written. Okay. Though your answer is correct, but the presentation will also matter in the exam. 103. So it says on 1st January 20x8, on 1st January x8, it purchased 40,000 equity shares at the rate of $3 per share, right? And also it paid transaction costs at the rate of 3,000. Okay. Now it says that on 31st December 2008, on 31st December x8, the value of equity share is equity shares are worth $6 per share. Now the question is asking you what amount in respect of these shares would be shown in investment in equity instruments. So what is the carrying amount of investment in equity shares? Please tell me the answer. This is what is the question asking. That's a very easy question. That's a very easy question. Let me see who can answer it correctly. $240, that is 40,000 multiplied by 6 is 240,000. But my question doesn't stop here. Okay, okay, so this instrument is through FVTOCI. Okay, tell me what is the amount that will be transferred to OCI. That's my question. That's my question. Not asking the question, but I am asking. Tell me what is the amount that should be transferred to OCI. What is the amount that should be transferred to OCI? $120. In OCI, what is the amount that we will capitalize here? It will be 40,000 multiplied by 3, plus we will capitalize the transaction cost as well, right? In OCI, that's what I said, right? So it will be what? 40,000 multiplied by 3 is 120. 120 plus 3 is 123,000. 123,000. Now what is the fair value change from 123 to 240? 123 to 240, what is the fair value change? So 240 minus 123, 240 minus 123 is 117. OCI is 117,000. Is it clear, guys? Is it clear, guys, everyone? Now what if this instrument, what if it is at FVTPL? In that case, the instrument will be recorded at 120. 3,000 will be transferred to P&L here itself. Right, 120 to 240 is 120,000. So this 120,000 should be transferred to P&L again. Is that clear, guys? Is that clear to everyone? Is that clear to everyone how the presentation will change? How the presentation will change? Is that clear to everyone? 3,000 will be transferred to P&L upfrontly because in FBT P&L transaction costs are transferred to P&L. Exactly, Priyanka. Now the remaining 120,000 from 120 to 120 will be transferred to P&L, right? So that's how it will be recognized. So I believe financial instruments you guys are clear on. Now let's move on to the chapter called inventories. Topic 2, inventories. Topic 2, inventories. Topic 2, inventories. Now what is the meaning of inventories? Inventories means what? Held for sale. Held for sale in ordinary course of activities, right? Held for sale in the ordinary course of activities, right? Held for sale in the ordinary course of activities is called as inventories. Is called as inventories. Is that clear, everyone? Now, how is inventory measured? Coming to point number 2, how is inventory measured? Inventory is measured initially at cost price. Inventory is measured initially at cost price. Right? And now, what is the bifurcation of this cost? Cost includes purchase price, the price at which you have purchased the raw materials, purchase price of raw materials, plus the price to convert the raw materials into the finished goods, price to convert the raw materials into the finished goods, right? The cost of conversion, which will include the direct cost, the labor cost, the production overhead costs, But always remember, whenever you are taking production overhead costs, you should take at normal capacity. That's a question in the mistake. That is a question in the examiner report which is given, that the student wrote that the production overheads has to be taken at actual capacity. No, production overheads has to be taken at normal capacity. Production overheads has to be taken at normal capacity. Okay. Now all other directly attributable costs incurred to bring the inventory in the location and condition intended by the management. Location and condition intended by the management. So purchase price plus the cost of conversion plus other directly attributable costs incurred to bring the inventory in the location and condition intended by the management. Okay, but yes, we need to understand that these are the costs which are specifically not considered in the initial recognition of cost. What are those costs? Storage cost, like warehouse rent cost, rent of warehouse, it will not be included. Admin overheads, it will not be included. General overheads, it will not be included. Selling cost, it will not be included. Abnormal waste, it will not be included. Normal waste will be included. That's why I am telling production overheads at normal capacity. Because the normal capacity includes the effect of normal wastage, right? Actual capacity includes the effect of abnormal waste also, right? So we have to take it normal capacity, not actual capacity, not actual levels. Okay, always remember this one. Production overheads we have to take at normal capacity. The question will give you both the data. The question might give you both the data. So you have to be very diligent that you are taking only the normal capacity and not the actual capacity. And you have to exclude these costs: storage costs, admin and general overheads, selling costs, abnormal waste. Normal waste will be included. I am writing here. Normal waste will be included. It will be included. Okay. Now subsequently, how it will be recognized? Subsequently, initially we discussed. Subsequently, as we know, inventory is recognized at cost or NRV, whichever is lower. Inventory is recognized subsequently how? Cost or NRV, whichever is lower. Is that clear, guys? Is that clear so far? Please confirm, then only I'll move ahead. Inventory is recognized subsequently at cost or NRV, whichever is lower. Please confirm, guys. Dipti, Naman, Vidisa, Akshit, Priyanka, Diksha, Manav. Okay, fair enough. Fair enough. Now, okay. Subsequently, it is recognized at lower of cost or NRV. Lower of cost or NRV. Now, how will the cost be measured subsequently? So subsequently, the cost will be measured using either FIFO method, weighted average method, or specific unit identification method. Unit identification method, guys, is applied on, you can say, the items which are not interchangeable. Let's suppose cars, right? A specific model will have a specific price, right? So in that case, we identify the cost by units, by specific units. Okay. FIFO weighted average is applied when the items are interchangeable. Like let's suppose pen, right? Like let's suppose pen, they are interchangeable. They are interchangeable, right? Let's suppose calculators, they are interchangeable, right? Let's suppose in general stores, the grocery stores, the items are interchangeable. There we can use FIFO or weighted average, right? Now that's how you will determine the cost. Coming to NRV, how to determine the net realizable value? How to determine the net realizable value? So for that, understand, if the goods is a finished goods, if the goods is a finished good, then the net realizable value will be net realizable value means selling price minus cost to sell. Selling price minus cost to sell. But if it is work in progress, this is very important, guys. This is very important. This is very important. Student make mistake multiple times in the exam. Very important. Work in progress. Work in progress is very important, guys. Okay. In that, what will happen is the NRV will be estimated selling price. NRV will be estimated selling price minus the cost to sell minus the estimated cost to complete the product. 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 Are you understanding it, guys? Estimated cost to complete the product, right? So estimated selling price minus cost to sell minus estimated cost to complete. Estimated cost to complete is something additional which we have to take care in this case. Estimated cost to complete. Is that clear, everyone? Is that clear, everyone? Estimated cost to complete. Okay. Understand one more thing, guys, that LIFO is not allowed. LIFO is not allowed. LIFO is not allowed. Is it clear, everyone? Now let's solve it off. Let's solve certain questions. Inventories. Question number 127. Okay. At 31st December 2004, Lich company had in inventory 100 items of work in progress. 100 units of work in progress. Now, if it is work in progress, it will be valued at cost or NRV, whichever is lower, right? NRV will be equals to estimated selling price minus costs to sell minus costs to complete the product. Right now, let's understand this one now. Which had which had a cost of 14,900 to produce. So it says the cost is 14,900. Cost is $14,900. Now what is NRV? What is NRV? So it says that it is estimated that the work in progress would cost 13 per unit to complete. Okay, it says that the cost to complete is 13 per unit. So 13 multiplied by 100 is the cost to complete. Now, can they ask for calculation of FIFO and weighted average in exam? They can ask, Rinki, they can ask. Okay, but as that is very easy, so I'm not taking up that in the class. The ones which are very a little bit complex or tricky, that I'm taking in the class. Okay, it can be given straightly, it can be asked to calculate FIFO or weighted average, it can be asked both ways. Okay, now plus it says that each unit would then sell for 166 per unit. So estimated selling price is 166 per unit. Now what is the cost to sell? It says that direct selling costs are 2% of revenue, means 2% of 16600. This is the revenue, this is the selling cost, this is the cost to complete. So what is the amount? 16600 minus, what is the 2% of this one? 16600 multiplied by 0.02 is 332 minus 1300. So what is the amount? 16600 minus 332 minus 1300 is 14968. So what is the lower? Lower is 14,900, right? So the inventory will be recognized at this value. Inventory will be recognized at 14,900. Inventory will be recognized at lower of cost or NRV. Lower of cost or NRV. So cost is this much, cost is this much, NRV is this much. So what is the lower? Lower is 14,900. Lower is 14,900. Lower is 14,900. Is that clear, everyone? Is that clear, everyone? Now coming to next question, 131. Okay. Production overheads. Identify whether the following statements about IS2 inventories are correct or incorrect. Production overheads should be included in the cost on the basis of the company's actual level of capacity in the period. Tell me whether this is correct or incorrect. And if it is incorrect, then why? If it is correct, then why? 131. Production overheads should be included in the cost on the basis of company's actual level of capacity in the period. Is it correct or incorrect? No, normal activity. Very good, Diksha. Very good, Diksha. So it's incorrect. It should be normal level of activity, right? Normal level of activity. Now, second point. In arriving at the net realizable value of inventories, settlement discount should be deducted from the expected selling price. Tell me, will we deduct settlement discount or will we deduct the cost to sell? Settlement discount is a cash discount. We might deduct trade discount, but we cannot deduct settlement discount, right? So this is also incorrect. Now, in arriving at the cost of inventories, FIFO, LIFO and weighted average cost formulas are acceptable. Incorrect. LIFO is not allowed. LIFO is not allowed, right? It is permitted to value the finished goods inventories at materials plus labor cost only without adding production overheads. Is it? Is it? No, we will add production overheads. We will add production overheads, but at normal level of capacity, right? So this is also incorrect. So in when valuing the finished goods, will include the materials, labor plus production overheads at normal level of capacity. Is that clear, guys? Everyone? Is inventories clear to everyone? Is inventories clear to everyone? Okay. So now, guys, what we'll do, we'll take a 10 minutes quick break, and then we'll discuss the next three topics, okay, which are very small. So don't worry about that. So we'll take a 10 minutes break. We'll resume at 7:26 and sorry, 6:20, 6:36, 6:36, not 7:26. We'll resume at 7:36, 6:36. Okay, we'll resume at 6:36 p.m. and discuss the rest of the topics. Okay, guys? Let's resume back, guys. Let me know once you are back from break. Let's resume back, guys. Let me know once you are back from break. There are three small topics that we have to finish it off. Am I audible, guys? Am I audible to all of you? Please write in the chat box, guys. Let's resume. Is everything fine? Why is no one commenting in the chat box? Fair enough. Okay, guys, please come back. Please come back, guys. Just 1 minute away from starting the class. We're just 1 minute away. Guys, let's resume. So we are here to discuss topic 3, that is biological assets. Now, so guys, in biological assets, let's understand the whole flow of chapter biological assets. Okay, so basically biological assets means any living being. It can be trees, it can be plants, it can be trees, it can be plants, it can be anything. Okay, it can be trees, it can be plants, it can be horse, it can be cattle, it can be any animals, it can be any animals. Okay, all those things are called biological assets. But now we need to understand the scope of this chapter, scope of this standard. Okay, this is governed by IAS 41. Okay, which the name of the standard is agriculture. The name of the standard is agriculture. Okay, IAS 41, the name is agriculture. The name is agriculture. Okay, now let's understand the scope of the standard. Okay, so it says that the plants or animals can be of two types. One is bearer plant and one is others. Now bearer plants means plants or trees, not animals, plants or trees, not animals. Okay, we are not discussing animals, we are discussing only plants or trees which are held for production in the agricultural produce, the life of which is more than 1 year, and they are not held for disposal. To give an example, like mango tree, now to give another example, wheat plant. Tell me, wheat plant, what is the life of wheat plant? So the wheat plant is, when it's harvested, it's gone. The wheat plant, when it's harvested, it's gone, right? The bamboo tree, when it's harvested, it's gone. So the plant itself is an agricultural produce. We are not talking about that. We are talking about a tree which will give us agricultural produce every year. Like a mango tree. It will give us mangoes every year, right? So the mango tree is a bearer plant, and the mangoes which are the produce will be covered in the standard. The mango tree, which is the bearer plant, will be covered under property, plant and equipment. Okay, Bearer plants are covered under property, plant and equipment. Okay, but the agricultural produce of the bearer plant, that is the mangoes of the mango tree, are agricultural produce which will be covered in this chapter. Okay, now others, all biological assets other than bearer plant, that is all animals and the plants whose life is less than a year. All animals plus plants the life of which is more less than a year, because the plants whose life is more than 1 year is covered under bearer plant, right? So the what is biological assets which we will be discussing in this chapter is all animals plus the plant have a life which have a life of less than a year, plus the plants which have a life of less than a year. Okay, plants which have a life of less than a year are called biological assets, and they will be in the scope of IAS 41. They will be in the scope of IAS 41. Okay, now agricultural produce at the time of harvest, it will be in the scope of IAS 41. At the time of harvest, it will be in the scope of IAS 41. But later on, it will be dealt under IAS 2, that is inventory. Is it clear, guys? The flow is clear. Please tell me the flow is clear or not. If and what you can do is look at this diagram for 2 minutes, please. I think I have made this diagram in a manner that it will clarify a lot for biological assets. Definitely we'll understand the measurement also, that how actually it will be accounted for. But yes, first understand that what will be covered in this standard and what is not covered in this standard. It is then we'll go ahead and study how will this be accounted for. Tell me, guys, is it clear? Clear? Okay, fair enough. Now so we are discussing only about these ones and these ones. We are not discussing about these ones, right? Now how will this be measured? See, it will be measured at fair value less cost to sell. It will be measured at fair value less cost to sell. And if the fair value is not available, we can measure it at cost. Okay, so this is the first preference and this is the second preference. If the fair value is not available, then we can measure it at cost as well. If the fair value is not available, we can measure it at cost as well. Okay, fair value less cost of sale. But standard says if it is measured at fair value minus CTS once, it will always be measured at fair value minus cost to sell. Then we cannot say later on, let's suppose once we applied fair value less cost to sell, then later on we cannot say the fair value is not applicable and hence we are applying cost. No, we cannot say that. Okay, so if fair value is applicable once, it is applicable for the lifetime. Okay, we have to find the fair value on each reporting dates. Okay, and the difference between the fair value as of now between the reporting dates will be transferred to SPL. Difference between the fair value on each reporting date is transferred to SPL. Is transferred to SPL. Is that clear, guys? So understand that the biological assets or the agricultural produce is recorded at fair value less cost of sale. If fair value cannot be determined, we can continue measuring at cost. We can measure at cost. Once fair value is applicable, is determined once, then again we cannot go for cost. Then again we cannot go for cost. Okay. Then again we cannot go for cost. We have to measure it at fair value less cost of sale only. We can measure it at cost, fair value less cost of sale only. Is that clear, guys? Is that clear, guys? There is one question, though not that important, but yes, that top measurement rule remains same in case of cost as well as for subsequent years. Exactly, Akshit. Let's suppose in subsequent years also fair value is not determinable, then we can measure it at cost. Okay. If fair value is not available. Okay, so this is the first preference. Again, this is the first preference and this is the second preference. Is that clear, everyone? Akshit, Vidisha, Dipti, Diksha, Jishan, Naman, Rinki, Priyanka. Is it clear, everyone? Please confirm, guys. Then we'll move ahead. Okay, fair enough. Let's solve one question. If we measure at cost in initial year, then we can change to fair value in subsequent year. Yes, Akshay. We can measure in the cost in initial year and then subsequently we can change to fair value. But yes, we can measure at fair value. Once we measure at fair value, then again we cannot go at cost. Understood, Akshay? Is it clear, Akshay? Okay, now it is asking which of the following is not an outcome of biological transformation according to IAS 41 agriculture. Okay, see what is it says that what is the meaning of biological transformation. So biological transformation means growth. It means procreation, that is the birth of a new baby. Okay, or degeneration, but it doesn't mean harvest. Harvest is not the meaning of biological transformation. Okay, so biological transformation does not include harvest. Biological transformation does not include the harvest. It is already Dipti, can you zoom out? Want to see the chart? Okay, okay, we'll come to the chart. We'll come to the chart so that Dipti can see it again and we can. Yeah, I'm waiting here for 2 minutes, guys. So that everyone can see the chart. Guys, see the chart, read it and make yourself comfortable with the chart. Is it done? I'll wait here for 1 minute then. I'll wait here for 1 minute. Okay. Dipti, is it done? Okay, fair enough. Now, okay, let's move on to topic 4. Let's move on to topic 4, that is effects of changes in forex rates. Okay, guys, okay, what is the meaning of forex? Foreign currency, foreign currency, foreign currency. Okay, now to understand what is a foreign currency, first understand what is a functional currency. Functional currency means the currency in which the FS are prepared. Okay, FS are prepared, the primary currency of the entity. What is the primary currency? So the functional currency is the currency of primary economic environment of the entity. Okay, functional currency, that is called functional currency. Now, what is the meaning of primary economic environment? The indicators are the currency which influences the sale price, or in the currency of the competitive environment, the currency of the competitive environment in which the entity operates, or the currency which influences the cost price of the materials, labor, or overheads in, or the cost price basically. That currency is called as functional currency. The indicators are given in the book. I think you can read it from there. There is nothing to explain. There is nothing for me to explain in that indicators. Okay, so you can read it. There are primary indicators and there are secondary indicators. Okay, you can read it from the book. Basically, the secondary indicators are the currency in which the funding has been obtained, the currency in which the capital is structured. So all those things. Okay, all those things. The currency in which major loans has been taken. So all those things. Okay, now, so what is a functional currency? What is a functional foreign currency? What is a foreign currency now? So any currency other than functional currency, any currency other than functional currency is called as foreign currency. Is called as foreign currency. And in this era of globalization, we need to understand that we deal in foreign currency in day to day. You guys also deal, right? When you pay the fees to ACCA, when you pay your exam fees to ACCA, that is also in pounds, right? That is a foreign currency. That is a foreign currency, because for you guys, the primary economic environment, the functional currency is rupees, right? For you guys, it is rupees, INR, right? So the amount that you pay to ACCA, that is based out of UK, you pay in pounds, right? So that is also a foreign currency. That is also foreign currency. So if we at this small level can deal in foreign currencies, then think about the companies. They are operating at a larger level, right? So they will definitely deal in foreign currency. The question that comes up is, how will they record this foreign currency in their books of accounts? How will they record this foreign currency in their books of account? Okay. So now it says that there can be two things. One is foreign currency monetary items. What is the meaning of foreign currency monetary items? What is the meaning of foreign currency monetary items? Can anyone answer? What is the meaning of foreign currency monetary items? So basically, any monetary item, basically any monetary item is receivable or payable as per the contract, receivable or payable as per the contract, receivable or payable as per the contract, and the amount of receivable or payable is fixed. Amount of receivable or payable is fixed in foreign currency. Fixed in foreign currency. Let me write that. Fixed in foreign currency. Fixed in foreign currency. The amount of receivable or payable is fixed in foreign currency. Those items are called foreign currency monetary items. And the forex gain, FX gain or loss, whether realized or unrealized, will be transferred to SPL. Will be transferred to SPL. Will be transferred to SPL. Is it clear, guys? Is it clear to all? Is it clear to all? We will definitely take up a question on this one. But tell me, is it clear? Is it clear, guys? Now, let's take up a question on this one. Let's take up a question on this one and solve it off. Question number 185. Question number 185. Misten Company buys goods priced at euro 50,000 from a Dutch company on 1st November 2008. Okay. So on 1st November X8, Misten Company buys goods at euro 50,000. Okay. Now, so what is the entry that it will pass? Trade purchases goods, right? So it is. Tell me what is the entry. Tell me what is the entry. Purchases account debit to trade payables, right? Purchases account debit to trade payables, right? Now, how much? Euro 50,000. And what is the rate? What is the rate? 1.63 is to $1. 1.63 is to $1. Tell me what is the dollar equivalent amount? What is the dollar equivalent amount? What is the dollar equivalent amount? 30. What is dollar equivalent amount? Tell me. What is the dollar equivalent amount on 1st November 20x8? What is the dollar equivalent amount on 1st November 20x8? 30675. Very good, Vidisa. So it is 30675. Okay. Now, what does it say? The invoice is due for settlement in 2 equal installments. Okay, in 2 equal installments. First installment is due on 1st December. 1st December X8, and the second installment is due on 1st January 20x9. Okay. Now, the exchange rate has moved from the exchange rate is 1.63 here. It has moved to 1.61 here, and it has moved to 1.64 here. Now, tell me what is the amount that is paid here? Euro 25,000 and euro 25,000, right? Tell me yes or no, guys. Tell me yes or no. This is not paid, means unpaid. Right? Now, tell me what is the amount that will be paid here? Amount paid in dollars. Tell me what is the amount paid in dollars. Tell me. That is 25,000 divided by 1.61 is equals to how much? 25,000 divided by 1.61 is 15528. 15528 is paid dollar. How much is recorded here? Dollar. For this one, what is recorded here? 30675. 30675 divided by 2 is 15338 is recorded, and we have paid 15528. So don't you think we have a loss? We paid extra of how much? 15228 is 109. Tell me what is the loss? Tell me what is the loss? 109, right? 15338 minus 15528 is 190, not 1109. 190, loss of $190. Loss of $190. Tell me yes or no. This is realized loss. This is realized loss. Now, coming to here. How much is the equivalent dollar amount? 25,000 divided by 1.64 is equals to dollar 25,000 divided by 1.64 is 15244. 15244, and we have recorded how much? 15338, right? Because 50% is paid here, 50% paid here, and 50% still remains to be paid here. 15% unpaid here, right? So unpaid, we will have to restate 15244, but we have recorded how much? 15338. So definitely we have an unrealized gain of how much? 15244 minus 15338 is 94. We have an unrealized gain of 94. So what is the total amount? Total gain or loss? What is the total gain or loss? Total loss or net loss of negative 190 plus 94 is equals to what amount? 94 minus 190 is 96. $96 is the amount. $96 is the amount. This is a gain and this is a loss, right? So net loss of 96. So now this is the answer. Here you will write 96 loss, negative 96 loss. Is that clear, guys? So basically what happens is, foreign currency monetary items we restate on every reporting date. And the realized or unrealized gain or loss is transferred to P&L. We restate on every reporting date and the realized or unrealized gain or loss is transferred to P&L account. Is that clear, guys? Let's suppose in this example itself, if this was not paid, let's suppose this is paid, right? Let's suppose this is not paid. Nothing is paid here. Okay, nothing is paid here. Then what happens? Okay, or rather than, I'll write it separately. Just give me a minute, please. I'll write it separately. I want to explain one more point here. 50,000 is the trade payables is euro 50,000 is equivalent to dollar 30675 here, right? The amount was rupees, it was euro, how much? 1.63 per dollar, and the amount is here, the conversion rate is euro 1.64 per dollar. Then what will we do? Let's suppose nothing is paid. Then what will we do? First we'll restate this one. We'll see what is the balance. As per this rate. Okay, so we'll say 50,000 divided by 1.64 is equals to 30487. 30487 means we have recorded 30675. The value is reduced to 30487. The trade payables has reduced. Means your liability is reduced. That is a gain. So how will you record that? So you will record trade payables account debit to unrealized FX gain, and this will be transferred to P&L. And what is the amount? 30675 minus 30487, that is 188, right? Now one more thing in this one itself. Let's suppose it was euro 50,000 here, which is convertible to dollar 30675 here, right? And the rate was euro 1.63 per dollar. And let's suppose everything is paid here, fully paid here, but the exchange rate is dollar euro 1.61 per dollar, right? So what is the amount paid? Amount paid is euro 50,000 divided by 1.61 is equals to how many dollars we have paid. How many dollars we have paid? 50,000 divided by 1.61 is 31056 we have paid. 31056 we have paid, but we have recorded a liability of how much? 30675. So what is the extra that we have paid? What is the extra that did we pay? 31056 minus 30675 is 381. This is a realized loss. This will also go to SPL. Now is it clear, everyone? Dipti, Vidisha, Akshit, Naman, Manav, Priyanka, is it clear, everyone? Diksha, is it clear, everyone, guys? Please confirm if this logic is clear. Okay, fair enough. Now for capital assets, if the capital assets are at cost model, then we will follow the cost model, and there is no impact of forex. Okay, I'll write here, no impact of forex changes. No impact of forex changes. Okay, no impact of forex changes, no impact. But if the asset is at revaluation model, then what will we do? The fair value of the asset, right? We have to fair value the asset. Then how will we determine the fair value? So first we determine the fair value in the forex rate. First we determine the fair value in the foreign exchange rate. Okay, and then we will convert that forex exchange rate, that for fair value in foreign currency. Then we will convert the fair value in foreign currency to the functional currency using the exchange rate on the date of conversion. Right? And that will give us for revaluation gain or loss, which will be transferred to OCI, that is revaluation surplus. Okay, let me take up an example on this one also. There is no question in the book in your practice kit, but there is a activity 5 of the BPP workbook that we can discuss. Definitely, let's discuss it off. So it says Tinker Company operates in A land and its functional currency is $8. On 1st January 20x3, Tinker Company purchases, let me just, activity 5, okay, of reporting financial performance of BPP workbook. Okay, now what does it say? It says that on 1st January 2003, this company purchased a land, okay, for in foreign currency B dollars, 5.6 million. Okay, this functional currency is A dollars. Purchased in B dollars means foreign currency, right? This conversion rate is 8 per dollar, 8 per A dollar. Okay, so what is the value? Value in A dollar is how much? Tell me. 56 lakh divided by 8 is 7 lakhs, 700,000. $700,000, right? The value of the land that will be recorded. So it will be recorded how? Land account debit to bank. This is 700,000. 700,000. Is it a foreign currency monetary item? No, this is a capital asset. Let's suppose this amount is not paid. This amount is not paid, so it is a trade payable. This trade payable would have become foreign currency monetary item. This trade payable would have been foreign currency monetary item, right? But this land is not a foreign currency monetary item. This is a capital asset at revaluation model. At revaluation model. At revaluation model. Okay, this is a property, plant and equipment. This is a property, plant and equipment. Now it says that under the revaluation model on 31st December X3 same year end, it says the fair value PPE at revaluation model. The fair value is 70 lakhs, 7 million. The fair value is 7 million. The fair value is 7 million for this property, for this land 7 million. Okay. Now the question is, how will you record the 7 million B dollars? 7 million B dollars. So now this is the fair value in foreign currency. Convert into fair value in functional currency. How will you convert that? Using the rate on this date. What is the rate on this date? 7, right? So $1 divided by 7 B dollars is the conversion rate. I'll highlight the conversion rate. I'll highlight the conversion rate here also. Now, so what is the fair value in functional currency? What is the fair value in functional currency? That is 7 million divided by 7 is 1 million. 1 million A dollars. 1 million A dollars. Now, so 1 million A dollar is the fair value and the cost is 700,000. So what is the entry? What is the increase? What is the increase? What is the increase? The increase is how much? 300,000. Right? And this will be transferred where? OCI. This will be transferred where? OCI. So what is the entry? Entry will be land account debit. Land account debit to revaluation surplus. How much? $300,000. $300,000. Now, what if this would have been a depreciable asset? For depreciable assets, let me write for depreciable assets. This for depreciable assets. For depreciable assets. OCI or P&L for investment property. P&L for investment property. Okay, for depreciable assets. For depreciable assets, carrying amount. Okay, now is a fair value in foreign currency multiplied by exchange rate minus carrying amount on date of revaluation. Carrying amount on date of revaluation. And that's what we did here also, right? But since there was no depreciation, the carrying amount is the cost itself. Is that clear, everyone? Is that clear, everyone? Is that clear, everyone? Is that clear, everyone? Is that clear, everyone, guys? Please confirm if it is clear. We will move on to our last topic. Come on, guys, please answer. Clear? Okay, fair enough. Now let us move on to the last topic for the day. Topic 5. Yes, Naman, please tell me. Tell me your query, Naman. Land is deemed to be as IP, so why you transfer to OCI? When did we discuss that land is deemed to be a investment property? It can be property, plant and equipment also, right? If there is a vacant land, then that is deemed to be an IP. Land that is used in my in the production or supply of goods or services, that can be property, plant equipment, right? A vacant land will be investment property, will be deemed as investment property, right? But not the land which is being used for self purposes will not be transferred to will not be investment property. Is it clear, Naman? Okay, fair enough. Now coming to the last topic, that is non-current assets held for sale and discontinued operations. Now, when will the assets be classified as held for sale? Okay, guys, we need to understand. Then there are certain conditions which is given in the standard basis which we can classify any non-current assets as held for sale, and the conditions are: the assets should be available for immediate sale in its present condition. In its present condition, whatever condition it is as of now, it should be available for sale. It is then only it can be classified as held for sale. Okay, if we say that no, the asset has to be repaired and then we will classify as held for sale, then yes, then we will sell it off. Then yes, the asset can be classified as held for sale only after the repairs, not now. If the asset is available for sale in its present condition, it is then that the asset is eligible to be classified as held for sale. Okay, the entity should be committed to make the sale. That is, the sale should be highly probable, and the sale should be done within 12 months from the date of classification. The sale should be made within 12 months from the date of classification. If these conditions get satisfied, then we can classify any assets as held for sale. As held for sale. Now comes the question: what will change if we classify any asset as held for sale? What will change if we classify any asset as held for sale? Guys, what will change is generally the non-current assets are classified as non-current, right, in the top. Now, but if we classify it as held for sale, that will be classified as other current assets. So we will write in the presentation, we will discuss in the presentation, if any asset is classified as held for sale, it is then reclassified. It is then reclassified as other current assets. It is reclassified as other current assets. Now the question comes up: at what value? So the value is either the carrying amount or the fair value less cost of sale, or the lower of carrying amount or fair value less cost of sale. Now this one is more or less like impairment itself. But in impairment, we compare. We record the value asset at lower of carrying amount or fair value or value in use. But now understand, guys, that if the asset is classified as held for sale, will we use the asset? No, we will not use the asset, right? And hence value in use is off. We will not consider value in use. Now we will be impairing the asset in relation to fair value, that is the value which we will derive if we sell the asset. Right? So fair value less cost to sell. But yes, guys, always understand, whenever you are taking cost of sale, do not consider transportation costs. If fair value is as per IFRS 13 on fair value measurement. See, if the question says the fair value is per IFRS 13, then the cost of sale should not include transportation cost. Why? Because IFRS 13 says fair value is net of transportation cost. But if the question solely says sale price, then yes, in the cost to sale include transportation cost. If the question specifically mentions fair value or fair value as per IFRS 13, it is then only will consider this point. Is it clear, guys? Is it clear, guys? A very small point, but yes, it can fetch you 2 marks. It can fetch you 2 marks in the exam, right? So if the question says, let me write it here. If the question says like this, sale price, if the question mentions sale price, then consider transportation costs as cost to sale. But if the question says either fair value, or if the question says fair value as per IFRS 13, then in that case do not include transportation costs as cost to sell. Is that clear, guys? Is that clear to all? Fair enough. Fair enough. Now comes there is also, we see the question is asking you what is the meaning of discontinued operations. What is the meaning of discontinued operations? So guys, understand that discontinued operations is a separate major line of business. Okay, major line of business, or a geographical area of operations, Okay. Now, or we can also say that a discontinued operation is a subsidiary acquired for the purpose of resale. Subsidiary acquired for the purpose of resale is also a discontinued operation. Okay, or we can say separate major line of business or a geographical area of operations being disposed of under a single coordinated plan. Okay, separate major line of business is a discontinued operation. Basically a major, let's suppose if McDonald wants to say that I want to exit India, that's a separate line of business, that's a major geographical area of operations, it can be discontinuing operations. But if it says that McDonald's says that I want to close one of the outlets in Bangalore city, then that's not a discontinued operations, because that's not a separate major line of business or a geographical area of operations, right? Is that clear, guys? The meaning of discontinued operation is clear all of you? The meaning of discontinued operation is clear to all of you? The meaning of discontinued operation is clear to all of you? Please confirm, guys. Please confirm. Is it clear all of you? Okay, fair enough. Let's solve one question then. Non-current assets held for sale and discontinued operation. Coppola company has a separate line of business. Okay, let me take up an example for that also. Let's suppose ITC says that I want to discontinue with tobacco industry, or I want to discontinue with restaurants chain of business, then that's a separate major line of business. Or ITC says that I want to discontinue with my paper division, right? Or Reliance says that I want to discontinue with the petroleum division, that's a separate major line of business, right? Separate segment of business, a major segment of business, right? Let's suppose talking about me, I have my CA firm, I teach students also, right? So if I say that I want to discontinue my CA firm and only focus on teaching students, that's a separate line of business for me, right? That's a separate line of business for me. Is that clear, guys? Okay, now let's solve one question. Coppola company has a factory with a carrying amount of 1.8 million dollars. Okay, now what is the question number? 186. 186 is the question number. Okay, on 30th November 2006, it says that on 30th November X6, it has a carrying amount of $1.8 million. Now management has agreed to sell the factory to Francis company, which is due to complete on 1st January 20x7. The sales contract was agreed and decision to sell the factory was announced on 1st December 2006. Relevant information, okay, this says on 1st December X6, that is the very next day, right? Now, so the carrying amount will remain the same, right? Now, it says on this date, the fair value is 2.4 million. So what is the fair value less cost to sell? So fair value is 2.4 minus 2.3. So 2.4 minus 0.3. 2.4 minus 0.3 is 2.1 million. So what is the lower? Lower is still 1.8 million. Still lower is 1.8 million. Right? What is the question asking? What is the carrying amount of the factory for inclusion in the financial statements of Coppola company as at 31st December? Okay, let's find out 31st December as well. On 31st December X6. Now on this date, it is classified as held for sale. On this date, it is classified as held for sale. Now once the asset gets classified as held for sale, okay, depreciation stops. Depreciation stops. Why? Because we depreciate only non-current assets. We don't depreciate current assets, right? Depreciation stops. Let me write in the notes also. In the measurement I'll write with this one, with red pen I'll write. Once classified as held for sale, depreciation ceases. After classified as held for sale, if assets is sold just after 1 day after the year, and how to treat this sale this year? 1 day after the year end. It's sold after the year end, right, Priyanka? So on the reporting date, we'll still classify as held for sale, and in the next year we'll record the sale transaction. Okay, because still on the reporting date, the asset was not sold. It is sold 1 day after the year end, right? So depreciation stops. So the carrying amount will remain the same here also. The carrying amount remains the same as 1.8 million. Right, now what is the fair value? Okay, it says that relevant information to this factory is correct at both at 1st December and 31st December. So it says the fair value remains the same. It also remains 2.1 million. So the lower is again 1.8 million. Right? So what the factory will be recognized at what price? 1.8 million. Is it clear, everyone? Is it clear, everyone? Is it clear, everyone, guys? Okay, fair enough. Guys, anyone have any other queries they want me to take it up? Otherwise, I'm done for the day. Yes, I'll share the notes right after this class. In the WhatsApp group, I'll share in the WhatsApp group. Okay, that's all for the day, guys. That's all for the day. That's all for the day. Anyone have any other queries? Tell me, guys. Any queries? Anyone? No? Okay. Thank you, guys. Yes, Akshit, I'll say that I'll see to your queries. Yesterday I didn't get the time to look into it, but yes, I'll see to it today. Okay. That's all for the day, guys. Thank you. Bye bye. Bye bye.